Mahesh Nindurkar joins us. Mahesh, good morning. Thank you for joining us. What is the first reaction you got from your clients and from your investor base when you, in a sense, shared your budget take with them? Are they happy? Are they excited? Do you think the budget has ticked all the boxes?
Yeah, hi, good morning, Nikunj. Uh, so the thing is, I would say that in general, over a period of time, from the market standpoint, budget has become, less big of an event, and rightly so, and that's how it should be. I mean, we don't want to see a budget creating market volatility all the time. Obviously, it has some stock specific impact as such, but yeah, but by and large, I would say that I think it's quite well received the fact that the government has resisted the temptation to go populist in a pre-election year, had stayed the course very much on fiscal deficit reduction. The borrowing program appears reasonable. The government assumptions on revenue etc. appear to be quite reasonable. And the most positive and the biggest positive surprise has been the big focus on the capex growth of 24% on an adjusted basis. That's a pretty robust number to look at. So yes, I would say that given the tight situation that we have been in, I think it's a budget that has been quite well balanced, and yes, has ticked the boxes in terms of what could have been done. Obviously, it is coming at the cost of something else. I mean, you cannot have fiscal consolidation, you cannot have 24% capex growth without costing you anything. And the cost is that the non-capex part of the government expenditure has grown by only 2% on a YOY basis, which will probably be a sentimental dampener for those expecting a big rural push, etc.
There is one standout loser, and that's the insurance sector. So, as an institutional research brokerage firm, what is your view on the Indian insurance sector going forward, considering that India is now moving into a new tax regime, and we know that insurance, in a sense, historically has been an instrument of choice for tax savers also, and going forward, that will change.
Yeah, see, the thing is, over a period of time, what we have seen the government doing gradually, step by step, is reducing the tax incentives and reducing the number of instruments and the number of choices that you have to kind of, manage your personal tax rates. And I think what has happened in insurance is one more step in that direction. I mean, if you recall, it started off with basically the change in definition of long-term in case of debt securities. Then there was some short-term capital gains tax on equities and some long-term capital gains tax on equities and so on. So my sense is that this is a step in that direction, and to the extent that the finance minister has also compensated a little bit by reducing tax rate at the bottom end, but at the top end as well. So I think these are compensating factor from a broader perspective. For insurance companies, yes, these high ticket investment oriented items were about 10 to 20% of the total APE for different companies. So there is going to be some hit, on that. Although we are still awaiting other clarification in terms of, even if those, the returns from the high ticket investments become taxable, whether they're eligible for the usual indexation benefit, etc., or not. But having said that, yes, there's going to be that impact on the, one-time impact, on the insurance growth. And I think to some extent the stock prices are reflecting that. But I feel that it's more like a one-time impact. I don't think it really changes the trajectory of the growth of the insurance market per se.
Mesh, I'm going to just move a little bit outside the ambit of the budget and talk about what's really happening in the current market environment and all the news flow around the Adani Group now that the FPO last night was called back. You think it's an event which is of global interest and in that sense sort of an image builder for India this way or that?
See, the way I look at it from the stock market point of view is that the group has come out with some clarification in terms of the exposure to the various the state owned banking system, the private banking system. LIC has come out with its own disclosures. Some of the other banks have come up with their own disclosures as well. So the way I look at it is that it's not really a systemic risk for the Indian banking system or the Indian financial system, so to speak. Uh, so so the way I look at it is that it's basically should not be viewed as a risk for the system as a whole.
Yeah, absolutely. That's not at all what I was meaning. But tell me, getting back to the budget then, Mahesh, just wanted to understand. I can see that in your note you've talked about as to how the budget clearly stands to benefit the rural plays. So those companies do good because of the capex push. There is going to be the infra theme, which the market already has caught on and continues to favor as well. If you were to draw an analogy in terms of stock market sectors and stocks which stand to benefit or become even dearer after the budget, what's the list like?
I think clearly there are two very clear beneficiaries according to me. One is obviously the capex related plays, um, with an obvious push coming from the central government, which was more or better than what we were expecting. And I also want to highlight that which is that outside the central government budget, but I believe that going forward in FY24 and beyond, the other two segments of the capex driver, which is the state governments and also the private sector, are also likely to pick up. Uh, Over the last couple of years, the state government have been kind of dragging their capex spends, but now the fiscal deficit and the debt to GDP ratio for the state governments is very close to the pre-pandemic level. Basically, the fiscal deficit is back to pre-pandemic level. The debt to GDP ratio is slightly higher, but not way higher. So I think that paves the way for the states to actually up the capex game, going forward. And we are seeing some initial signs of the private sector capex also building up. So my sense is that in addition to the central government effort, there are these other two drivers as well, which actually makes the scenario quite optimistic for investment related plays, and particularly the contracting and the capex and the infra sector plays as such. So that's clearly one beneficiary. The second beneficiary is also the tobacco stocks, because the tax increase has been quite modest. And my sense is that given the fact that we are now out of the purview of the
Right.
GST compensation bit, which means that the next tax
Right.
event for tobacco is probably now 16 months away. So that's the second big beneficiary.
A 16% duty hike is what we saw on tobacco, the sin duty hike, as it's called, making a comeback after nearly 3 years. And you did see the from ITC to Godfrey Phillips being punished in trade. Very quickly, Mahesh, before we let you go, any word when it comes, you've spoken about the public sector banks with respect to Adani. Now, we tried from the DPEM secretary yesterday, really, really hard to figure out what could happen with the smaller banks, if they could be up for disinvestment, strategic sales, privatization. We couldn't get much from that interview, but what is it that you folks in the markets are expecting, just seeing the recent share run up?
Okay, just because that, I want to clarify on the previous point on the tobacco taxation. See, 16% increase in NCCD, and NCCD itself is only 10% of the total tobacco taxation. So effectively, we're talking about only 2 to 3% increase in the tobacco taxation, which is actually quite a positive development from my perspective. So therefore, I just want to make that point clear that tobacco taxation has been quite benign. So that should be seen quite favorably, according to me. To your other point on the state-owned banks, I think the state-owned banks, valuations, are looking pretty attractive. I mean, it was attractive. It has gotten better over the last few days. And yes, there have been some concerns, on the asset quality, as such. But my sense, as I mentioned in one of the previous answers as well, that I don't think we are going to get into any NPL cycle, so to speak. And the credit growth outlook looks pretty reasonable. 14-15% should be the number to be looking forward to. And I continue to believe that the provisioning costs will continue to trend down. So I would say some of the larger state-owned banks appear to be quite interesting bet at this point in time.
Right. Mahesh, great to have you on the show today. Thanks as always for taking the time out. Got to address the market open. And while the Nifty, of course, is just mildly soft right now, it's the Adani group of names which are actually seeing a big turnaround. Adani Enterprises opens up straight shot, 10% higher. ACC Ambuja as well holding out in trade. Let's just bring up some of the other names as well from the group. Let's see what Wilmar, what Adani Ports, the entire gamut of the Adani shares is up to. Transmission starts off lower, Wilmar down 5%, Green Energy down 10%. So a bit of a tug of war between the Adani group of names. ACC, Ambuja, Adani Enterprises all in the green, rest of them all in the red. Now to the other stocks in focus this morning, and you've got Britannia, wherein there's been a strong operating performance that they've posted for the quarter gone by. The margins are at a near record high, that of 19.5%. Britannia starts off higher by about 1% as we speak. ITC, after that aberration coming in, and now the market digesting that tax which has been implied is just very, very minuscule. Some semblance coming in on ITC, holding up 1%, 365 is where the stock is. Ashok Leyland came out with its numbers. Eicher Motors came out with its numbers. Alembic Pharma came out with its numbers. Tata Chemical came out with its numbers, and all of them in the positive. PVR, it's launched 5 multiplexes in Chennai, so look out for that as well. And then of course IDFC First, wherein IDFC is going to invest about 2,200 crore rupees in IDFC First Bank. So they've raised the stake now to 40%. That's another stock which is in focus. Hero MotoCorp, it's a third consecutive month of sales below the 4 lakh unit number. It's down about 6.5% on a year-on-year basis, so look out for that stock. Hindustan Copper, not such an impressive set of numbers, nor is the case for Ajanta Pharma, wherein the profits have declined by 30%. To the big movers from yesterday, and HDFC Life, let's see whether there is any recovery in sight for HDFC Life. After that 11.5% knock that the stock took yesterday, it's still down 4%. I want to check in on what SBI Life as well is up to. In fact, the entire insurance gamut, SBI Life has seen a bit of a recovery, 1.25% higher. LIC down about 2%. Indian Hotels, Gujarat Gas, Dixon, Chola Finance, the big dhamaka movers from yesterday. Today, Indian Hotels lower, 321 is where that stock is.
Okay, it's okay. Now, what do we have? We have Adani Ports. Specifically, I'm pointing this one out because on my Bloomberg screen, it is the top traded stock in terms of the value of transaction, and it was down 10%. It's in FNO. So if the stock has seen, so this is pure technical margin selling, which I think is just not ebbing for Adani group of stocks. Adani Enterprises, volumes are higher than Reliance. Volumes are higher than that of ICICI Bank. ICICI Bank, we're discussing that with Kunal, down to 2.5%. So it's one of those phases in the market where everything is just getting smoked. LIC below, I think another couple of, another 4-5% in LIC will make a fresh lifetime low. IDC is the only one which is holding on. Technology continues to chug along very, very smartly. Kunal, let's identify a first trade.
Well, go with a large cap name, that's HDFC Limited, stock opening at 2740 odd levels. I think it's an interesting buying zone for HDFC Limited. Would expect the stock to get into a recovery phase. So that's the stock which I would look to buy.
All right, that's HDFC, Kunal's first trade this morning. Looking at the screen, Naresh, what's your outlook? What's the first trade?
So that would be Ashok Leyland. The stock is on verge of a breakout above the 152 mark. So at 148, 149, preempting the possible move here, keeping a stop loss at 147 and expecting it to go higher.
All right, Ashok Leyland, HDFC, those are the first trades from our market experts. 17,477 on the index. Adani Group stocks continue to remain in the spotlight. But let's hear out the big budget verdict from market veteran Vallabh Bhansali. He remains bullish on the India story, saying that some sentimental moves in the markets will not derail the market as a whole, adding that we will see a drastically different second half as India always rebounds from a crisis. He continues to prefer financials as a sector.
Extraordinary budget. And I say extraordinary because in a year like this, and you prefaced it pretty well, it is a tightrope to walk which means I have to give something to everyone. I have to make sure that consumption sustains and that growth is not given a go by. And when private sector is not spending as much as one would desire, I have to make up for the shortfall, and not only the shortfall, but take the country to where the aspiration is. And the government has not missed out on anything. And therefore, in the context of what's happening in the world, what lies ahead in 2024, in terms of the fiscal attitude of the government, whether it is consolidation or the tax policy, the announcement, the sounds were not just sounds, but they were met by actions. And the last point is the kind of grip that the government has shown on every aspect of the economy, every aspect of the political reality in terms of people expectations. I think has been a wonderful, wonderful experience listening and reading the budget.
What do you make of the budget assumptions? They may be conservative, but 2022 has taught us that there is a global geopolitical tension which could put everything in disarray. So do you think somewhere with the growth assumptions, the finance minister has taken some risk, stroke leap of faith?
I would say that, conservatism that we saw last year has continued in fair measure. It may not be the same because last year revenue expectation was way below, what a lot of analysts picked up. This year also, if you look at the growth in taxes, whether it is GST or direct taxes, I think they are quite reasonable. If you look at year-on-year growth percentages, and I won't go into too much minutiae, but I find they're quite reasonable, because I think one thing that we have to understand is the way UPI is growing, formalization of the economy is growing, way GST compliance is improving, and therefore some of the bets that the government has taken, that if they press the pedal hard as they have on infrastructure spending, roads, railways, and other areas, consumption should sustain, and capex should start. So things keep changing. If the world is in stress, as we see today, it's not going to remain that way forever. And this is a whole 12-month period. Our economy has, inherent some lopsidedness, which means what happens second half is a very different story. So when I look at, what could happen in second half when the world has, dealt with inflation better, they start getting the benefit of base effect, etc., I think you're going to see a very dramatically different second half. And therefore, on balance, the second thing is that we were hit last year by very high crude prices. It was amazing geopolitics and diplomacy that we were able to save ourselves by, standing our ground and importing Russian crude. But crude prices themselves are coming down. And therefore, we think that there are a couple of places where the finance minister, has created a kind of secret reserve. And one of them is subsidies. And therefore, there could be positive surprises in some of those pockets. On the whole, we think between dividends and between subsidies and between tax revenue, between government capex, there is enough cushion to take some shock in case there was a shortfall. The RBI governor, last point is, has already indicated that, they are at the end of, hiking cycle. And you could say something there also, where the government has taken a fairly conservative number on interest cost. Therefore, there are several places on net, I would say, I'm pretty comfortable with the conservatism in the budget.
The increase in capital expenditure by nearly 2.5 lakh crore. Do you think the economy can actually absorb and digest this kind of an capital expenditure? Because this kind of an capital expenditure could also risk the inflation factor going higher.
So, firstly, we could not take expenditure for a long period of time. Now, because, we didn't have capacity on the supply side, contractors and planning and so on and so forth. Now, the way road building and, the train building, etc., have been happening in the country, the supply chain is, quite in place. There is competition. And therefore, I do not think that in an economy as large as, more than 300 lakh crores, 10 lakh crores, 2.5 lakh crores additionally can, move the needle. So I'm absolutely comfortable that this is not an inflation causing thing at all.
No changes in taxes. It has addressed just about everyone from the middle class taxpayer to the poor in the economy. What really spooked the markets?
I think technical factors, because as we could see that the market had responded positively to the budget. And then after a point, as selling hit the market, profit taking or exit opportunity, etc., that is spooked the market, and which is very healthy. The market must be a place where all kinds of players clear their positions. And we all know, I think it's pretty oft repeated on financial channels, that China is resurging very strongly. And within the emerging basket, because Indian markets are at all-time high, it is natural for a fund manager to divert some of the assets to China. Though China market has gone up sharply, people still think that the China reopening story may be bigger than being thought at this point of time. That's a bet. So, money is diverting primarily to that. It is not an India sell as much as diverting to China. And the Indian stock prices are at record high in any case. And given the uncertainty, that one factor that we have to keep in mind is exports. Exports are sluggish. And in a slowing world economy, our exports, have to do a lot to keep up. So, there are those risks. So given that, okay, even if India plays out the way we all expect, which will be fantastic for India, but from a global investor's point of view, the risks and rewards may be evenly placed. And therefore, it's an easy trade to sell India and buy China. Will that go on forever? Not at all. At some point of time, as the numbers play out, as Indian economy stands up to, how we have stood the ground in COVID and number of crises, I think some of this confidence will come back. Also, the interest rate cycle in the US, at some point of time, it will give a direction, which means then investable surpluses will start growing. The risk off will, start turning risk on. India cannot be a market which will not attract new inflows for any sustainable long period of time. It's a quarter or two, money will come back to India.
So, Mr. Bansali, the flight of capital from foreign investors, which was a record number for 2022 and for 2023 also, numbers don't look all that appealing. Do you think it's temporary? Because if India is the best story in the town, then it's a matter of not choice but compulsion that flows will come back?
Absolutely. I think the number to see for us is going to be FDI. And as long as that FDI, and we're already seeing that big players who write hundreds of millions of dollars of checks are looking at India very positively. And I think what we are losing in terms of FII, to some extent, will be and those flows are very volatile. We know that they go very quickly and they come back very quickly. So I think 2 quarters of great performance, that money will start coming back to India, and that will it will get synchronized into the interest rate cycles in those countries, performance in India, etc.
Mr. Bansali, suddenly markets are in a risk-off mode. Leverage companies are getting beaten down. Banks again are on the butcher block given what has happened to Adani group of stocks in terms of a sell-off. Do you think the fear in the market is slightly overdone?
Well, you cannot pinpoint, a position, but I think if you recognize that we were at, all-time high, risk off is not all that unwarranted. And given, as we discussed already, that, what's happening in other markets in the world, interest rate cycles, etc. So I think I consider all these corrections very healthy. The strength of the market can be measured only by the corrections it is able to take. And so I think we are allowing those corrections. It's fantastic that, through COVID, we absorbed so much selling. Through all this, we have absorbed selling. We saw a correction in banks, some time back, and the banks came back. One particular bank had a, big investor sellout, big correction of some 10, 12, 15%, and the stock has come back. So I think there are many, many stories where, either there are unique problems like a merger or a succession, etc. We have seen tremendous resilience. Through all this, flows into mutual funds and SIP are continuing. Flows into insurance companies are continuing. So I think it's something to observe, but not unilaterally that, foreigners are selling, so what will happen? I think the domestics are getting stronger by the day. If you just look at the size of the economy today, I mean, we are a very significant economy. This 10% nominal growth, that's, we will assume 10, 11%, 10, 11% every year. Very soon, the kind of economy that we will have, per capita income with serious, purchasing power for large number of Indians, some 20, 30%, start getting into that zone. I think all the investable money will want to come to India. There is no story in the world on a 10-year basis that comes anywhere close to where India is. So, forget a few quarters here and there, forget a few, investors coming in, going out. That story is not going anywhere.
It's unfortunate that when global media is raising concerns because of a liquidation which has happened in Adani group of stocks about India's ability and the banking structure, do you think we should safely ignore it because the internal strength of our banking system and the economy is far greater than what concerns everybody now seems to be raising?
Nikunj, we have seen so many of these things. For 30 years, I've been seeing this, the collapse of Master Gain. We have come back always. Crisis after crisis, we have come back. Because, fortunately, since we started giving freedoms, 91, every time we have a wave of good freedoms, every time we have a, freedom plus good governance, we have grown disproportionately. I think we have seen good governance and so the policies, I do not see any doubts, I have zero doubts.
When we spoke last, Mr. Bansala, you did speak about specifics. You said, look, banks are in a fine fettle. The capex and industrial cycle was in an upturn. So as we look into 2023 and beyond, where do you think, purely in terms of an outperformance and a thematic outperformance, we should expect going forward? What we should expect going forward?
So when you have a story like this, so obviously, as people consume more, financial sector will always be a favorite circle. So, whenever there are corrections in that sector, people will want to buy. Similarly, the whole consumption basket is going to be like that. If you asked me about balance sheet last year, I told you that, it is first time in several decades that we had all the three balance sheets in good shape, corporate, banks, and the government. The fourth balance sheet, which may be under some stress currently, is the personal balance sheets. And that's where the finance minister, listened very carefully and has given direct tax benefit. So suddenly, large number of people who were in tax bracket have gone out. It has a huge sentiment effect. If interest rates come down further, the EMI pressure comes down further, I think some of this stress, which may be there to some extent, will start correcting. One thing that we haven't seen is still the result of, crops. Some of the crops have done phenomenally. And, when that starts coming into this, so some of the stress that you may be seeing, one area where, real estate prices have gone up very high, and now you have some marginal change in real estate, taxation policy or, capital gains reinvestment policy. So maybe some of those cases, some pockets where real estate was very high, may see some corrections. So bade desh mein, choti baatein to kuch hoti rahegi. So except for those three balance sheets remain intact. I think the kind of dividends that will come out of banks is going to be staggering. Both to the government and, private sector. So bank after bank, is not talking of, any significant credit cost. And we have seen the expansion of NIMs in many banks. So even if on a larger base, some of these things get corrected, still there will be very, very healthy profits. So with government spending all of this with a reduced fiscal deficit, that is the most important thing. Therefore, any shortfall that could arise from any of these balance sheet stresses, if at all, is not going to be there. the fiscal deficit, the borrowing number, the conservatism in the estimates, etc., all give us confidence that this will continue.
Nilkan Mishra, co-head of Equity Strategy Asia Pacific and India Equity Strategist with Credit Suisse, joins us now. Nilkan, good morning. Thank you for joining us. The budget was good, but the market reaction was dull. So before we get into details of budget, are you surprised with what you saw in the market after such a decent budget, and even though everybody got much more than they wanted, the market reaction yesterday was rather dull. Post budget, the market sold off as if something really negative came out.
I don't think the sell-off was related to the budget, to be honest. I think the implications for equity markets from the budget anyway generally tend to be quite minor these days. Most of the reforms get announced outside the budget cycle. The budget is mostly a signal on what the priorities of the government are. And the stronger signal on about the budget came from the bond market, where bond yields came off, and that was a sign that the bond market trusts the government's numbers and appreciates the government's fiscal conservatism. I think the market correction, as we were discussing with previous speaker as well, was more related to disclosures and the stocks related to, and the decline in stocks related to a particular group.
Okay. Now the budget. How would you...
Not the budget.
Right. Let's understand the budget. The budget, in a sense, is growth oriented. But while growth is the priority of the government and capital expenditure, and there is a focus in creating that multiplier effect, do you think this budget, which is growth oriented, could also end up stoking inflation? Because that, again, could be a fallout of such a high growth dominated budget.
I would disagree that this is a growth-oriented budget, in the sense that if you are bringing down your fiscal deficit from 6.4% to 5.9%, you are actually reducing the support that the government provides to the economy. And it is a very timely support, meaning that as the economy then starts to come back on its feet, then the support that the government needs to provide is less. Now, where the government has shown, I think, positive intent is the quality of the expenditure. So there is a lot of savings in FY24, which is expected on food subsidy, fertilizer subsidy, the NREGA payout. So as a job market normalizes, the demand for NREGA work comes off, and therefore the allocations to NREGA come off. The anticipated increase in PM Kisan payouts also did not happen. So as this occurs, there is some fiscal space that opens up, and that space has been filled up with very encouraging spending on capital expenditure. So this is the medium-term growth impact of this is going to be positive. I don't think in aggregate terms this would actually stoke inflation. This, in a way, if you think about 6.4 coming to 5.9 and hopefully 5.4 and 4.5, the government's support to the economy is coming off. So this is actually, in a way, slowing down the economy if you were to see it in isolation. So the inflationary pressures from this, I think, are extremely unlikely.
What about the big uptick towards expenditure for pockets like railways especially? What would be the net resultant impact of that on the economy? And do you think the capex cycle, which already has started, let's say 18 to 24 months ago, will only strengthen further?
So the total expenditure goes up from about 42 trillion, so 42 lakh crores, to about 45 trillion, 45 lakh crores. Now, as a percentage of GDP expenditure, general government expenditure, remember that when we do this analysis, it is unwise to just look at the center. We need to look at center and states together. The combined expenditure to GDP is actually still flat, and therefore, at an aggregate level, the government is not really adding to demand. Now, as I said earlier, the quality of that expenditure is improving, but on an aggregate level, I don't think the government is adding to demand. Now, on the railways in particular, I have been a strong votary for a very long time that India needs to completely reimagine how much capex it needs to do in railways. In fact, I have been saying for 2-3 years that instead of 1.5-2 lakh crores of capex that railways does, we should do 10 lakh crores of capex because there is massive expansion potential in rail capacity, which would be very important to bring down logistics costs and all the long-term advantages that come with it. The challenge has been not availability of fiscal space, but the ability of the railways to execute that capex, to execute those projects. Railways has been for a very long time used to doing 5 crore, 10 crore local projects, and which are very hard to scale up. Now, what is happening encouragingly and has happened last year, and we are hopeful that this process will continue, is that the railways is for the first time last year managed, or this fiscal year, managed to sort of absorb the capex and complete its funding, and also ask for more. Means that they are finally starting to ramp up on the expenditure in a constructive way, and therefore the allocation of nearly 2.9 lakh crores, if you add the extra budgetary allocations, is a very remarkably, I mean, it's a remarkably strong number. And that, I think, is, again, I mean, we'll have to see how rapidly the railways scale up on this. But if they're able to execute on that, I think this is very positive for our logistical costs. Imagine roads and rail both competing with each other. So lots of expressways, lots of national highways coming up at the same time, and thus bringing down freight costs on the road, coming up at the same time as railways is expanding capacity. And if you prefer my bias is towards railways than roads, because railways uses energy which can be locally produced. Roads do not do that. So as an intent, I think this is great. If they're able to execute, I don't think additional 50,000 crores of capex in a 300 trillion rupee economy will actually cause inflation. But I think this will be very positive for the medium-term outlook for India.
Just drawing bits from what you've already said right now, the fact that you disagree that the budget is not growth oriented, but at the same time the government has at least made its intent clear that they are going to push capex. So what is it going to come at the cost of? Is the economy going to slow down, or do you think private capex will pick up?
No, but see, we cannot expect the government to keep spending and supporting the economy forever, right? Remember that our debt to GDP is still at 82-83%. For it to start falling, our primary deficit, which is fiscal deficit minus the interest payouts, put it very simply, it needs to come down to 0.4, 0.5%. We are currently at 3%. So now, if the government does it too slowly, meaning that if the fiscal consolidation is too rapid, it can create its own problems, because economies like India cannot shrink into fiscal health, meaning that you cannot suddenly stop spending because your debt to GDP is too high. You have to support the economy, because the nominal GDP, the denominator in the debt to GDP ratio, has to be supported. So it has to be a gradual process. But you cannot keep it at that high level, because I think this level of primary deficit is unsustainable. So the government does need to slow down and allow the private sector to. So as I said, if the government needs to come in. I mean, if you look at pure Keynesian economics, only when aggregate demand is subdued. So during COVID, when everyone was saving a lot of money, someone needed to add to demand, and the government then takes up that responsibility. And as the economy opens up, as private sector demand picks up, as Nikunj was saying, private sector capex is now, there are very good signs that that's starting to come back. The government needs to pull back. So put it in a global context, right? So where are we? We are still in a situation where we have a very significant balance of payment deficit. Now, what that means is that our imports are too high and exports are going to weaken because the world is slowing. If that is the case, then you need to bring the balance of payment deficit down. So we are short of dollars. Now, for that to happen, you need to bring down fiscal deficit moderately. You need to use a variety of tools, so like higher interest rates, a weaker currency, and try to get some external capital. But anyway, so the first three measures, lower fiscal deficit, slightly higher interest rates, and a weaker currency, which can slow down the economy in the near term, all have to be used in prudence so that the balance of payments deficit is addressed. Because this is, so I think this is the key takeaway for me from the budget, that the government has preferred stability over near-term growth. right? And that is extremely important. If you see why India over the past 1.5 years, despite massive macroeconomic challenges globally and financial market turbulence, has been a remarkably steady ship, it is because of this factor.
Right.
All right, Neelkant, we'll let you go on that note. Thanks much for sharing with us your verdict on the budget, what you've made of it, as well as the kind of market reaction we've seen. Seeing a recovery in the broader markets for now at about 17,624. Quick break, be right back.
Babe, I love this apartment. Island kitchen.
लॉक करें?
और जब ये नया फ्लाईओवर बन जाएगा ना, mom and dad will be just 20 minutes away.
तो परफेक्ट नहीं है घर. इसीलिए housing.com with maximum properties. housing.com पर से perfect.
All right, I just want to mark some of the Adani Group stocks as well because, you know, it continues to, you know, you want to do a bit of a double take looking at some of those names and trade. Adani Enterprises, for instance, after it got off to a fairly shaky start, now you're seeing that recovery having kicked into an Adani Enterprises. Take a look at Adani Ports. It seems to have pretty much replicated this kind of a chart pattern as you're looking at that recovery. You can see something like an Adani Power as well. Adani Wilmar remains under pressure. Adani Transmission continues to languish, and Adani Green as well is down by about 10% in today's trading session. Ambuja, ACC within that basket continue to remain the bright spots, and a quick look at NDTV as well. But all eyes on numbers. Titan set to report its quarterly performance today. What exactly are we expecting in terms of the EBITDA margin, in terms of the headline numbers, as well as the festive and wedding demand that could potentially aid the numbers? We've got Vinny here to walk us through those details. Vinny.
So for the jewelry retailer, Titan, obviously, let's not forget, jewelry segment accounts to 80% of the business. So what we're expecting, and obviously what the company gave in the Q3 update, is the jewelry segment is expected to see an 11% growth coming in. Watches and eyewear segment is also expected to see a decent growth coming in. So overall, the revenue growth is expected, what we're expecting is expected at around 15% is what we could say coming in for the company. Profits expected to see a mild growth of around 5.5%, while margins expected to see a contraction this time as well. 13.6% is what we're expecting the EBITDA margins at, around 100 basis point contraction over there. Growth mainly in the jewelry segment was why? Because of the wedding season that was there, festive season that was there in Q3, and overall the store expansion strategy of that is worked out well. So yes, that is keeping jewelry segment a beat, and that is what is overall supporting the growth. Other than that, the strong buyers, healthy store expansion, and that is something that is driving the performance of jewelry segment as well as the overall business. EBITDA margins declining because of the, you know, despite the improved salience, because of the weakness in the operating leverage. So keep an eye out in terms of the factors, demand trends, outlook on international business, what are the expansion plans there, is something we're watching out for.
Okay, so that's Titan for you. Thanks, Vinny, for joining in with that update. Now let's talk about HDFC Limited and its numbers that will be out. What is it the street is expecting? My colleague Harshatya now joining us with the ET Now poll of the street expectations from HDFC Limited. Good morning, Harsh. You know, you look at the HDFC twins, at least for the markets, the elephants have started dancing. We've been hearing about the turnaround. So what's the ET Now poll?
Well, yes, you're looking at net interest income expected to rise around 13% on a year-on-year basis. 4850 crore is where that's expected at. And PAT, therefore, to translate to around 13.5 to 14%. So somewhere in the mid-teens is where we're looking at that PAT number to come through. AUM growth also expected to be quite healthy. 16 to 17% is what we're pecking it at. Around 7 lakh crore is where that AUM number will go to. And mind you, in terms of within the AUM, of course, the individual basket is what will be the most important. 4% QOQ is where that individual loan growth is expected to be at. And overall loan growth, of course, as I did mention, something around 16 to 17%. NIMs are expected to start expanding marginally, but nothing meaningful at least expected on the NIMs front. But of course, that's a key factor that one will have to look out for with regard to management commentary. The other piece, of course, is home loan demand. How is that going given the rate hikes coming through is another key monitorable. One will have to look at the impact of the rate hikes on home loan demand. And of course, now that the budget has come through, the impact of interest rates on home loans going away from that deduction will also start mattering. So a couple of factors really which are expected to play out. Very interesting times at the moment.
Okay, so that's what you need to watch out for when it comes to HDFC Limited. Thanks a lot, Harsh, for joining in with